What's up, everybody? Welcome back to the channel. Today we're going to be talking about trading with a full-time job. So the first thing you need to do to begin your trading career is developing a strategy. And the most important thing to realize is that if you have a full-time job, you're not going to be able to stare at the market all day. So what does this mean? It means you can't day trade, and it means that you're going to want to keep it simple, stupid. The thing that I personally do is I utilize daily and weekly charts. So this means that each price point that you get on your chart is either comprehensive of an entire day, if not entire week. So this is kind of a longer term trading strategy. It's going to allow you to, really look at this when you want to, and it's going to allow for there to be less pieces of data, which means there's less information for you to interpret. And then the most important thing of your strategy is, what is the basis of that strategy? Are you going to be trying to do mean reversion? Are you going to be trend following? Are you going to use moving averages? Are you going to use statistics? Are you going to use a range of high lows? So this is all stuff you want to figure out, and you want to make sure that you're not going crazy like our buddy over here. You want to make sure that you find a strategy that fits you, and we're going to kind of talk about how you can do that if you have a full-time job. So the first thing you need to do if you want to trade with a full-time job is you need to fund your account. I started this out with just $250. You don't need thousands of dollars to start, and actually it's better to start with a smaller amount because you're not going to be very good when you first begin. And if you're losing consistently, it's a lot better to lose with a small amount of money than it is to drop in, $30,000 and, instantly lose 10% of that. Starting out with a smaller amount is going to make you feel more comfortable when you lose, just because that money that you're losing isn't going to be such a substantial amount of your net worth. And, starting out, just be consistent with your funding. If you really want to be dedicated to this, you're going to have to put in money on a consistent basis. So if you get paid, match that. If you get paid daily, match that. If you get paid weekly, match that. Or if you get paid monthly, match that. So just always adding money to your account is really going to be important. You're never going to trade $1,000 into $1 million. That's a ridiculous return. If you think you're capable of doing that, then you better be in the top 0.5% of traders. There's not a lot of people on this earth that can do that. And just to kind of show you, over the last 3 years, I've been growing my trading account. Like I said, started with $250, and then just within the Schwab account here, I have close to, $76,000 in there. So it just goes to show, over a short period of time, 3 years is not very long. You can go from almost no money to close to six figures in your account if you're consistent with adding, and if you can utilize, money making strategies to grow that account without having to add your own money. So, big takeaway here is you're going to want to start small, and as you grow, just keep adding every single week. Add on your own schedule, but just make sure that you're consistently adding. Next thing you're going to want to do is idea generation. So this is how you create what we call a watch list. Watch list is kind of your hot list of stocks that you really want to hone in on. And there's a couple ways to find those stocks. What I personally do is I use screeners. I have a video on how to screen for growth stocks that I'll make sure to link in the chat, or a link in the comments below. So go and look for that. That's my preferred way to do that. I think it offers more flexibility, and it gives you the option to really hone in on what you want to trade. But if you want to do a more generalized way, the easiest thing's going to be do is just trade ETFs. Everyone's heard of the S&P, everyone's heard of the Qs. But then there's also triple leveraged ETNs that you can trade that more or less 3 times track the market. So SPXL, that is a 3 times bullish leveraged SPY fund, and then TQQ is 3x bullish fund for the Qs. And then the other thing is just trade the same assets. Some people only trade NVIDIA. Some people only trade Facebook. Some people only trade Exxon. If you are willing to just watch the same stock or same asset every single day, and that's the only vehicle you trade, you take every single signal, you really back test it and find out that this is what the winning strategy is going to be. That's fine. It's Some might say that's boring, but this isn't supposed to be fun. It's not supposed to be something that entertains you. You're trading to make money and for nothing else. This shouldn't be to keep you over during the day if you're kind of bored and you don't want to check your email. This is a serious business, and you need to treat it that way. So if it comes down to you only watch Exxon and that's the only thing you ever trade, then that's fine. And as long as you're making money, that's all that matters. So idea generation, you want to create a watch list. We'll kind of go into that a little bit more. Idea generation, find what you want to trade and only look at that when you're actually trading. So now we're at watching the market at work. So you can't monitor the market constantly, but you can check it periodically. If you know anything, or if you've kind of had a generalization of what the stock market is, you might see that, hey, you need 12 screens in order to do anything. You got to be staring at them all day. That's not true at all. You can trade off your laptop. You can trade off your phone if you need to. All that's important is being able to look at the price action and then interpret it and make your move from there. So if you can't check the market constantly, say maybe you're a bus driver or something, or you work construction, and you have tasks that don't allow you to look at your phone. Here's probably 4 times where you really need to look at it throughout the 6.5 hours that the market's open. So you want to check the open. You want to check a couple hours after the open. You can check one on your lunch, and then this is the most important one. Maybe check an hour to 30 minutes before the close, if not 5 minutes before. The closing price is the most important price. It's the price that sets your margin requirements. It's the price that your account closes at every day. Charles Dow is famous for saying the closing price is the most important price. So you don't need to be staring at your charts every day. You don't need massive screens with everything going on. All you need is a phone if that's all you can handle, and then just take some time out of your day. Take 5 minutes. If you're sitting on the toilet, check your charts. And then you need to narrow your universe. So this is where your watch list becomes very important. If you're only able to check the market for 5 minutes a day, then you need to be able to look at all your watch list stocks in under 5 minutes. Must have a predefined watch list coming into the day, and then use your idea generation. Keeping a narrow focus during the day helps you because there's going to be a lot of fear and greed going on, and we'll kind of touch on that. Order execution. You're going to want to set stop orders while you're at work, and what a stop order is, it's an order to buy or sell an asset at a specified price once the stock is traded at or through a specified price. If you're one of those people that really can't check it that often, the most important thing for you, it's going to be automating your trading. And that's what stop orders do. They allow you to automate your trading. They also allow for maximum profits. What that means is if you want to, trail your stop, say you bought a stock at 100 and it runs up to 105 and you want to sell at 104, you can set a sell stop to execute if price closes below $104 or through $104, then you'll get out at exactly, roughly that amount right there. And if you weren't watching, say it slides through 104 and then by the time you look, it's already at 102, you lost a little bit of your profits there. So that's how that automation really allows for you to maximize the profits within your strategy. It also minimizes your losses. So if you bought a stock at 100, and you knew that you wanted to get out at 95, the minute that stock goes through 95, you're going to get out. Again, same sort of thing. You don't have to watch it all day. If the stock went through 95 and by the time you check it, it's already down to 89, you kind of just completely blew out of what your stop loss should be. So it really helps you minimize your loss. And then it also eliminates emotional trading. By automating your trading, it takes all of the thought out of it. As long as you input those orders, they will automatically execute, meaning that you don't even have to think. You don't have to double guess yourself. You won't have to say, hey, maybe let's just see how it handles down here. Maybe it'll bounce. No, you're getting out right away, and it makes sure that you don't get caught because you're emotionally trading. So here's an example of a buy stop. So what you want to do is you want to check what the current price is at. If you're doing a buy stop, you want to make sure that your stop price is above the current price, because you're going to want to enter this trade once price goes above a certain level. And then You set your quantity, you make sure you hit stop for the order type, you set your stop price, and then the timing. You can either do a good till canceled, which if you think that price is going to trade through that level in the next 3 or 4 days, this is what I always do. Or you can do a timing could be only for that day. So it all depends on what you think price should do at your current level. If it should trade through that level quickly, then maybe only do a current day. But if you want to give it some leeway and give it plenty of time to go through that level, then this is where good till cancel comes in. And then a sell stop. So this is when you already own a stock. Let's say you have 10 shares, you want to sell all 10 once price goes below 205. So in this case, your stop price has to be below the current price because if your stop price is above the current price, you'll immediately be executed at that price. And then same thing, good till canceled. This one comes in a lot more because if you're holding a stock, you may be in that position for a while, and as long as your stop price doesn't change, then this one will stay open. So that's really the basics behind setting a stop limit or a stop order. And there's a couple other ways you can do it, a stop limit, and those are all online if you want to look those up. Next up, you're going to want to maintain a routine. The only way to beat the market is to maintain a routine. You want to follow the same strategy, follow the same strategy, follow the same strategy. So here, this is the quintessential training routine. We got our boy Rocky running up the steps. This is how you should feel, even if you lose. As long as you follow your system, you should feel proud that you are maintaining a routine. And being able to maintain that routine is just going to make you a better trader. It's going to allow you to hone your skills and really find out where you're falling short within your current strategy. A lot of the times when you first start, you're kind of going to understand the basics of your strategy, but there's a lot of ins and outs, a lot of kind of subjective things that you really have to be able to feel. So following the same strategy allows you to really, develop those skills and find out how to maximize the strategy to your benefit. If you're constantly changing from one strategy to the next, you're never going to be able to find those finer motor skills within that strategy, and you're always going to be at the beginner level. Anything in life worth doing is going to take time, and maybe it takes you 5 years to really hone your strategy. But if you get that 1,000% return, you add a zero to your account, that's going to be life-changing money. And if you can do that consistently, then that's going to be the way for you to really prove to everyone how great of a trader you are and be able to retire early from your job. And then finally, I do all of my work on the weekends. Over here in California, the market's open Monday through Friday, 6:30 to 1:30. And when the market opens, there's volatility, there's greed, and there's fear. It's going to be impossible for you to truly make a smart decision about whether to buy or sell a stock if you've never looked at it before. And say you're looking at all these movers. You see this one stock's up 20%. And that's great, but if you're just in the mindset that you need to be buying whatever's going up, and you're not looking for it to come out of a proper base or really hit your exact pattern that you're looking for, then that's going to leave you to just trading based off greed and fear, fearful that you're going to miss out, greedy that you want all that extra money, and that volatility can really tear you up. So that's where the screeners and your idea generation comes into play. You should only be trading stocks that are already on your watch list. You should know exactly when you want to get in, exactly when you want to get out, and exactly the criteria of why you make that trade. So doing research on the weekends allows you to review your charts when there's absolutely no movement. It reduces the distractions and leaves you with a clear head during trading hours. So that's kind of the basics of trading with a full-time job. If you have any questions, feel free to put them in the chat below, and thanks for watching.